The biggest economic drivers in Canada, including population, jobs, and GDP, well, the numbers are all bleak. And they're having a profound effect on the housing market and vice versa, right? When we look at it, we find that last year alone, more than 106,000 people left Canada. That is the largest outflow dating back to the 1960s. Population growth in Ontario and BC just hit record lows. Meanwhile, unemployment in Toronto has climbed above 9% for the first time in 15 years, and construction jobs are vanishing by the tens of thousands. At the same time, Toronto's new home sales just posted their worst July in over 40 years. Inventories are piling up to all-time highs, and for the first time ever, rentals are outpacing purchases. That's right, more people are leasing or renting compared to buying. Today's episode is packed with updates from Toronto, Vancouver, and Canada as a whole. And of course, we are going to take a deep dive into the September GVRD numbers that have just come out. And we're going to share just how far prices have fallen and forecast as best we can how much lower they can probably go. The numbers today are extreme, to say the least. So let's take a look at how 2025 is shaping up and the major shifts that are happening right before our eyes. Starting off with some of these drivers. People leaving the country. 106,134 people have left Canada, or at least in the whole year of 2024. That is the most people to leave in a single year, dating back to 1967. On top of this, Ontario just saw the largest outflow of non-permanent residents in recorded history. In the first half of 2025, the combined population growth of Ontario and British Columbia has reached record lows. And that data goes all the way back to 1954. It feels like a mass exodus at this time.
And employment isn't looking any better either. The July labor force survey posted the largest non-COVID decline since 2018. The share of labor force out of work for at least 6 months is the highest it's been now since 2011. The unemployment rate in Canada's largest metro broke above 9% for the first time in 15 years. In fact, June payroll data showed that basically only government jobs are increasing. And that's not good news for a broad-based economy like ours. The largest decreases were found in construction, retail trade, and manufacturing. People are leaving, and they're definitely not buying homes. Listen to this. Active EI recipients hit 540,000. That's up 11% since just the start of this year. Canada unemployment benefits paid out a surge this year as well, 48% year over year compared to June of 2025. This all points to a much higher likelihood, in my opinion, of a rate cut. But remember, the BOC won't cut rates when times are good. They will cut to help stimulate the economy. And right now, it really needs it.
Something else that's struggling, and oddly enough, there's active voices in this region talking and begging or pleading for cuts. And that is, of course, the Toronto pre-sale or pre-construction market. Toronto's new homes market, it's flashing every possible red light imaginable, right? And the data, it's concerning. According to the latest numbers from both Altus Group and Build, BILD, July 2025 marked the worst July for new home sales in more than 40 years of record keeping. It's not a 40-year low, it's just the worst in 40 years. It is even worse than that brutal housing downturn of the 1990s. From January through July of this year, just 3,007 new homes were sold across the GTA. For context, during the same stretch in 1990, one of the toughest markets on record, there were more than 4,400 sales. That means we're now in essentially uncharted territory, with sales volumes lower than anything seen in decades. In July alone, there were just 359 total new home sales, which is a 48% drop year over year and a staggering 82% lower than the long-term 10-year average. Typically, July sales would hover somewhere around 1,900 units. Instead, they broke barely 350. On the pricing side, new condo benchmark prices held flat at just over $1 million, while single family prices fell 6% year over year to about $1.48 million. Inventory, meanwhile, it just keeps climbing. There is now about 20 months of new home supply sitting unsold. Though, you know what? I have to double check that. I think it's upwards of like 58 months. I got to double check that my chart, but we'll post it either way. Feel free to correct me in the comments below, but we'll put up the numbers. I think there's conflicting data here, but we've got a chart that shows either way. It is a staggering amount of time. Maybe that was just for new single families, but all in, I believe it's sitting around 58 months. Okay, moving on. Industry leaders are essentially warning that, this looks eerily like the 1990s downturn. I mean, obviously the numbers emulate it, which when we look back then took years to recover from and triggered major job losses across the construction and development industry. We've been reporting on that for a while, and the trajectory is basically already written. A gentleman named Justin Sherwood from Build put it bluntly, quote, "If government stands by, the pain will be deep and prolonged. Intervention is not optional, it's urgently due." Now, again, we know how incredibly polarizing the idea or concept of government intervention coming in to quote unquote save housing, not in our control which way they decide to go forward, but clearly the industry is asking for it. The federal government has promised some relief, like the proposed GST rebate for first-time home buyers on select new homes. But so far, the slowdown has been nothing short of relentless. And the industry is clear. Without the bold, coordinated policy action, GTA's housing market, and let's be honest, Vancouver and some of the rest of Canada, is at risk of grinding to a halt. Some would probably say we're already there. Bottom line is, we're not in a sales slump. Like, it's a structural crisis in the supply chain of new housing and the sale of new housing. And unless something happens soon, the ripple effects on jobs, affordability, and future housing supply, they could be pretty severe. We're going to share another chart here. New home sales in the three largest metros, which of course is Vancouver, Ottawa, and Toronto. They're down compared to 2021 by 80%. It is staggering, this chart. Again, for those on YouTube watching this, have a look at that chart. It kind of speaks for itself.
Tell me we're in a recession without saying the word recession. And there's a lot of data that points to that too. It's not just stuff we're reporting here. With that said, let's have a closer look here at renters versus buyers, because for the first time in history, the Toronto Real Estate Board leases are now outnumbering the sales. Buyers are completely priced out, or at the very least, they're completely checked out while this, while this restructuring is taking place. They've completely tuned out of buying, and they're turning to renting instead. In 2025, there have been 96,855 home purchases compared to 97,198 rental leases. The headlines and cost of living are pushing Canadians out of home ownership, and that is a very, very sad place to be.
Let's take a look now at housing starts, because these numbers are very telling as well. So the amount of renters that Ryan just kind of spoke to will likely increase as rental rates continue to become more and more attractive, right? There continues to be a record amount of rental units under construction. Over the past year, of the 213,000 housing starts, over 100,000 of those were purpose-built rentals. Plus, we've seen 3 straight months now with rental starts over 10,000 each month. The shift in percentage of owners versus renters, it looks to change dramatically over the upcoming years. Amazing to think, in a 3-year downward trending market, construction is booming. We literally just hit a new all-time high in dwellings under construction at 359,000, of which 170,000 of those are rentals. With population dropping, unemployment spiking, and many homes coming online, it's pretty obvious where future prices and rental rates are heading. Though it's also important to remember that this is not necessarily a nationwide phenomenon, and local markets will act accordingly. And one more note on this, we're sitting at record high amount of units under construction, yet the construction industry jobs are bleeding. And it sounds a little bit counterintuitive, but of course, what's happening is a lot of these people that as soon as they're off work, off the projects, there is absolutely nothing behind that for them to go to.
I think it's also important too to remind people how we ended up with so many rentals. We had a lot of strata projects that were under construction to be sold as strata units. only for developers to recognize that the market was shifting and as such converted their projects to rental purpose built only. And that surged the inventory coming forward. And that is conversely going to be the thing that crashes, I think, a lot of the condo market in terms of resale and in terms of what you can actually rent the condo for. So important note there, because it did seem to surge quite quickly, but it's actually developers that have swapped what the use of the building is going to be while it's under its development permit or it's under its building permit. Let's move over here to a bit of a mortgage update. I mean, if you're about to obtain a mortgage or renew one and you're curious what everyone else is doing, today the most common mortgage is a 3 to 4 year fixed term, followed by a variable mortgage, then a 5 plus year fixed, and lastly, less than a 3-year fixed. And as we know, around 60% of mortgage holders are renewing in 2025 and 2026 from essentially all-time low rates during COVID. The renewal cliff, as some have called it, is underway and proving so far it has been basically a nothing burger. Though CIBC just reported that there was going to be minimal impact from their borrower base, an 8% increase in payments for those renewing in 2025 and about a 6% increase for those renewing in 2026. And that is assuming, of course, that should rates hold around the 4%. Other banks are echoing this sentiment, meaning as of today, those with the most to lose, the banks, they don't appear to be too concerned. In fact, they've actually been lowering their loss provision amounts, demonstrating their faith in mortgage payments being paid for the most part, though that attitude could shift in the coming months.
So let's see if the updated mortgage arrears data agrees with this. And let's point out, of course, it is about a 3-month lag. I believe the numbers are out for June of 25 right now. So the arrears rate did in fact increase month over month from 0.22 up to 0.23%. This is the highest dating back to February. Yet we are still below the pre-COVID levels recorded back in April of 2020 when they were at 0.25%. That's Canada as a whole, right? Though it's important to note there are understandably areas of concern. Toronto arrears, for example, have spiked from 0.08% in 2023 up to 0.42% today. Toronto remains essentially the epicenter of the housing downturn or collapse, if you will, in that region. In Vancouver now, arrears rate rose from 0.005% in 2022 up to 0.27% today. Should this trend continue in the two major metros, obviously the national rate will rise with them. And always fun to reference good old America. So the latest data for the USA regarding their arrears rate, they're sitting at 1.57%. So they're more than 600% higher, 600% worse than Canada with their arrears. And again, always interesting to point out that you don't ever hear about that in the headlines, even at that percentage rate.
Let's touch on the economy because right now it's very difficult. And Canada's economy, as far as we're concerned, has hit the iceberg. And the damage is becoming harder to ignore. It feels like water is piling into the ship. Statistics Canada's latest GDP report shows the economy shrank by 0.4% in Q2, dragged down by exports collapsing by 7.5%. That drop alone shaved off nearly 2.5 percentage points of growth. Shows you how important our exporting part of our economy is. Some of this is tied to tariffs, of course, and front-loaded U.S. inventory and demand earlier this year. So Q3, I think, will reveal whether things have stabilized or if they're going to continue to get worse. But the broader picture isn't much better. Business investment is crumbling. Spending on machinery and equipment fell nearly 10%, and non-residential construction has dropped over 3%. That means Canada's already dire productivity crisis is getting worse. Instead of investing in things that grow the economy long term, capital is being completely pulled out, while more money than ever is being poured into housing. It's Bizarre. Residential investment actually rose 1.5%, with new construction jumping almost 4%. So, in other words, we're doubling down on the same sector that helped inflate the bubble in the first place. Even the Bank of Canada is warning this kind of imbalance is unsustainable. So, what kept GDP from looking even worse? Well, spending, revenue. Households increased consumption by 1.1%, led by a 5.6% surge in vehicle purchases, but incomes have barely grown, up just 0.2%, which means Canadians are dipping into their savings now to keep on spending. The savings rate has also dropped from 6% to 5% in just the last quarter. Then there's government spending, which jumped across the board. Shock. Consumption rose 1.3%, and investment, however you want to determine that, climbed to 2.1%. The cost, though, is staggering. Federal revenues, by comparison, fell to 4.2% after the consumer tax repeal, pushing Ottawa's balance sheet from a $4.1 billion surplus in Q1 to a $17.3 billion deficit in Q2. It's a $21.5 billion swing in 3 months. So yes, GDP looks better than it otherwise should, but is being propped up by unsustainable borrowing and spending from both households and government. It's a distortion. At the same time, we're seeing productive investment, the kind that actually builds long-term growth, is being cut back, while housing remains Canada's crutch. The bottom line, this isn't a warning of trouble ahead. The trouble is here. Icebergs hit, water's flowing in, and we're looking now for life rafts. Canada is steering deeper into risk, not away from it.
So just before we get into the updated Vancouver numbers, I want to share a bit of data on Toronto and the nation as a whole, because they really kind of are, well, how they emulate and how they differ is quite fascinating to look into. So starting with Toronto, Toronto's housing market, well, they just set another record. It feels like we say this almost every week or definitely every month now. So the latest data from the GTA shows real estate, well, their red lights are flashing as well, right? Sales struck near historic lows, inventories piling up to record highs, and prices continue to slide. Let's start with prices. The benchmark price of a typical GTA home dropped another 1.15% in August. And again, over 1% swing up or down in 1 month is a big number. It equates to about $11,300 or roughly $364 a day, if you want to break it down that way. Over the past year, prices are down 5.1% there. And compared to the February 2022 peak, homes are now selling for about 24% less. We're talking about a $312,000 drop from the highs, right? Now, obviously not everybody bought at the highs, but there was a point where homes were valued at that peak price. Now, sales activity, it's not offering much relief either. There were just over 5,200 sales in August, technically 2% higher than last year, but let's put that into perspective. It is still the second weakest August in 25 years. To get back to even the most modest sales volumes of like 2019, activity would need to rise by 57%. To match the pandemic boom of 2020, sales would need to more than double. At today's pace, that recovery feels like a bit of a pipe dream. Now, the bigger story, as it usually is inventory. In August, nearly 14,000 new listings hit the market. In August, normally a slow month, which is up, they're 9% higher year over year. Total active listings climbed to 27,500, the highest August on record for Toronto. To put that into perspective, inventory is now almost triple the levels we saw in 2021 when the market was at its tightest. The speed of the shift is pretty fascinating to watch, right? In just 4 years, Toronto went from record scarcity to record supply. That is dramatic, and that is being felt. Canada is already in the midst of its second largest housing correction ever. More about that in a second. And what we're seeing here could soon, ripple out into other regions, of course, right? With record number of new completions about to hit the market, record number of rental units about to hit the market. Many owners and investors planning to flip, well, guess what? They're likely stuck with properties that either they hold or they're going to have to price to market, which might feel a bit like a sting to some. The industry is trying to find silver linings right now. I guess we're trying to find some here too, but the reality is the reality. Some are saying, sure, the uptick in sales is great, but it is, you look at the big picture and it's, making a mountain out of a molehill, realistically, right? I think the reality is Toronto's housing market continues to be under what many would consider to be extreme levels of stress. Prices are down a quarter from the peak. Sales are scraping the bottom of the barrel and inventories at all-time highs, right? If this continues, the correction, it may still have a long way to go.
Yeah, Dan, I largely agree. I mean, we've seen a number of, and you see it typically on social media, it's a seasonal adjustment. We normally see sales spike a little bit now in the fall. But when you consider, people coming out and saying, hey, there's higher levels of activity, off of what is the question? And right now it's off of horrendous lows. And it's important to really understand the broader picture here and less so the, month by month. This is an overall collapse, I think, that we're going through right now. And there's been no macroeconomic environmental change yet. The government hasn't come up and substantially changed something to reverse this course or to stabilize it even. And so I think we're likely going to see a bit more of this. In fact, Canadian real estate is in the middle of one of the sharpest housing corrections in its history, and it's happening faster than almost anyone expected. According to the data from the U.S. Federal Reserve Bank of Dallas, real, meaning inflation-adjusted home prices have dropped more than 24% since peaking in early 2022. That makes this the second largest price correction ever recorded in Canada, already surpassing the early 1990s downturn and trailing only behind the brutal crash of the early 1980s. What makes this episode so remarkable isn't just the size of the drop, but the speed of which it's taking place. The correction is now 12 quarters deep, just 3 years from the peak to where we are today. By comparison, the early 1980s crash stretched over 14 quarters, and the early 1990s dragged on for more than 6 years. Even the foreign buyer mini bubble of 2017, which ended after 10 quarters, feels slow compared to what we're seeing now. Prices did tick up slightly in the most recent quarter, but by just 0.15%. And that doesn't mean we've hit bottom either. Inflation revisions often change the data and the story. And when you look at forward indicators like sales and inventory, the market is still weakening. In fact, after adjusting for inflation, Canadian home prices today are effectively cheaper than where they were back in 2017, but household incomes have not kept pace, meaning affordability is actually worse. The reality is this: Canada's housing bubble isn't deflating slowly, it's collapsing at a near record speed, and like blowing up a balloon and then just letting it go. Unless there's a dramatic shift in policy, credit, demographics, this correction could still run longer and deeper than most of us are prepared for.
Okay, let's get local. The Greater Vancouver real estate data is out for the month of August, and we've got all the highlights and the deep dive kind of behind the curtain looks. Let's share that with you right now. We always start off with the sales. What's the health of the market, or is this thing still in its deathbed? Well, in August, 1,942 homes sold. It's actually, 2.9% increase year over year. But, you always got to look at the big picture for a bit more of a reality check. And yeah, sales are low, 19% below that 10-year average.
Yeah, we move over to new listings now. They've declined for the fourth straight month. We're sitting at 4,230. It's 2.8% higher year over year and about 1.3% above the 10-year average.
Okay, so what does that all do for inventory? Well, inventory lowered for the second time in 2025, which again is pretty typical for summer months. It hit 15,601 homes available at the end of the month. In August, it dropped about 10% month over month. Again, big picture, well, let's do two things. Year over year, it's up 17.5%. So a lot more homes on the market than last year. And the big picture, that 10-year average, 37% more homes on the market than the 10-year average. So we are essentially entering into a fall market with well above the average amount of listings. So quite typically, of course, people either relist or choose to list right at the beginning of the month. I can share there was something like 724 listings that came on the first day of September. I think it was September 2nd, of course, the first being a holiday. And as of right now, 17,221 homes available for sale in GVRD. Little note on inventory. Do you remember how we just talked about Toronto hit a record all-time high amount of active inventory for the month of August? By comparison, GVRD, we are 27% lower than our August all-time high, which took place in 2008. So quite a difference between those two markets in that regard.
Yeah, moving over now to the sales to active ratio. Overall, we're sitting at 12%, and that's down 1% month over month. We've now been 15 months in a balanced marketplace, and it has not been at 11% or lower since April of 2020, which was the COVID shutdown. So only 1 month in the past 5 years has hit 11%, and we are teetering on it. When we break it down by asset class, we're looking now at 9% for detached homes. That's down 1%. 16% for townhomes, down 1%. 14% for apartments, which is down 1% from the month prior. All of it trending down and to the right.
So let's see what's happening in the world of foreclosures or court-ordered sales. Definitely a jump in detached, especially. They jumped about 10%, up 20 units, sitting just under 200 now. But interestingly, condos did not move at all. The exact same amount of foreclosures in condos as there was the month prior is now 124 of them. Multifamily, there's only 3, and land lowered down to 43. So there's total, I guess it washed out about 18 more foreclosures in total. It's continuing to rise, no question about it. There are a total of 369 foreclosures across the lower mainland today. Again, basically entirely movement in the detached market, all but certainly due to prices, right? A lot of these properties that were bought for 2-3+ million, a lot harder to cover those payments than your $600K condo.
Okay, moving over to days on market now. We're sitting at 26, which is up by 2 days over last month. And this is the 5th monthly increase in a row. And I suspect it's going to continue on this path in notching up kind of month by month here.
Lastly, we get to prices, and we start with HPI. The HPI dropped for the 5th straight month in 2025, lowering about $15,000 or 1.3% month over month. Again, anything over 1% up or down is a notable shift in prices. Prices are down 3.8% from this time last year. HPI average home here sits at $1,150,000. We're back to March 2023 prices, according to HPI, which is, it equates to a 28-month low. Prices are down. If we just look at this year, we kind of had a bit of a, well, not a peak, but an increase of prices to kick off the year. And they're down about 3.5% since the 2025 high, which happened in March. And of course, prices are down since then. Median actually jumped up about 22K to 955,000, whereas average prices were lower by 14,000 to 1,229,000. So that wraps it up. Here's the $1 million question, Ryan. How low will it go?
Well, it's funny. I don't know. And I don't think anyone does. And I don't think anyone who tells you actually knows. But I do think there are sort of signals in the marketplace to pay attention to. And I think right now, it's funny. I actually reminded myself of this. It was going through COVID when I remember when, prices were climbing 3% a month. They were just skyrocketing. And I remember on one episode, we said to each other that the cycles that we're going through appear to be getting shorter and more volatile and more often. And that was 3 years ago. And here we are today experiencing something very similar, but just on the opposite trajectory, right? And the laws of physics remain. I think at the end of the day here, Dan, the overall economy that Canada is in is bad. It's in really rough shape. And I think if we're going to fix this, we have to look at some inconvenient truths like opening up our resource sector and getting out our natural resources to the world to help fix our economy. Because we can't just keep printing money. We can't just keep throwing money that costs nothing to create and put it into the economy and expect things to get better. It's not going to. Things are going to get worse. And ultimately, the thing that's all propping all of this up is our confidence in the system itself. And right now, I think that confidence and that sentiment is lower than it's ever been. And so until we really start to see confidence improve in Canada overall, and that's going to require major economic reform, stuff we've been calling for years. The crisis is happening now. It's here. It's at our feet. We're screaming. It's right here. Everything that goes up must come down. And if we're going to continue on this path and we're going to come out of this okay, we have to open up new markets to the world. There's no other way. We're in a really, really tough position here with our back up against the wall, and we need to drop this partisan left and right and figure it out as Canadians. How are we going to make this better for everyone? Because right now, it's pretty bad for everyone.
So what I'm hearing is the $1 million question might become the $900,000 question pretty quick.
It's very possible.
No, appreciate your insights there. And yeah, it does feel like momentum is picking up in the absolute wrong way as far as the country is going. But let's have faith in the powers that be. Or not. That is up to us. Make your vote count. Okay. Well, as always, thank you so much for tuning in, listening. Hope you have a great weekend, and we will see you here next week.